We see these numbers everywhere, right? Flashing on our screens all over the news. But what does a stock price actually mean? Well, today, we're going to decode the incredible story of human emotion, belief, and psychology that's hiding behind that one simple figure.
All right, let's just jump right in. You see a number like this flashing on your screen. Let's say 210 bucks for a share of some big company. What is that number really telling you? Is it a fact? A score? What is it? Let's figure it out.
Now, if your first thought is, well, that's what a piece of that company is worth, hey, you're not alone. That's what most people think. But that's not the full picture. Not even close. In fact, that number is much more of a fleeting illusion than it is a hard fact. So that's what we're going to do. We're going to peel back the layers on what that number truly represents. Because it's not some static measure of worth. It's a dynamic, constantly changing snapshot of our collective belief about the future.
And to really get it, we have to start with the absolute basics. I mean, how is a single price even born from the chaos of millions of different opinions swirling around out there?
So here's the first huge piece of the puzzle. A stock price is simply the last price a buyer and a seller agreed on. That's it. It's not the price for all the shares in the company, just the price of the most recent single transaction that just happened. The best way to think about this is like a giant, continuous auction. Every second of the day, millions of tiny little auctions are happening, and every single one of them sets a new price. And in every one of these little auctions, you've got two sides. You have the bid, that's the highest price any buyer out there is willing to pay, and then you have the ask, that's the lowest price any seller is willing to accept. When those two numbers finally meet in the middle, bam, a trade happens, and that becomes the new stock price you see on the screen.
Okay, but that's just the mechanics, right? That doesn't really explain why prices shoot up or crash down. For that, we've got to look under the hood at the real engine driving this whole thing, human psychology.
So it kind of begs the question, doesn't it? Why would a buyer and a seller who have completely opposite goals ever agree on a price in the first place?
The answer is actually pretty simple. It's all about expectations. The buyer believes the company's future is looking bright, so the stock is going to go up. The seller, well, they might think the best days are in the past, or maybe they just found a better place to put their money. Every single trade is basically a disagreement about what the future holds. And those expectations are absolutely drenched in very human emotions. The market isn't some cold, perfect, logical machine. Nope, it's a swirling mix of fear, greed, optimism, and pessimism, and all of it is backed by billions and billions of dollars. The legendary investor Benjamin Graham put it perfectly. He said, in the short run, the market is a voting machine. It's basically a popularity contest, driven by all those emotions we just talked about. But, he said, in the long run, it is a weigh-in machine, where the company's actual performance, its real fundamental value, is what eventually matters most. All right, so if the price is all about expectations, then what shapes those expectations? Let's take a look at the actual information that fuels this whole engine. Well, a company's own actions are a huge driver. I mean, it makes sense, right? When a company's earnings grow, investors expect more profits in the future, and that tends to boost the price. When they do stock buybacks, they're reducing the supply of shares out there, which makes each one left over a little more valuable. And on the flip side, if they create a ton of new shares, that's called dilution, it spreads the value thinner, and that can lower the price. But here is a really critical idea that trips a lot of people up. The market's reaction isn't actually about the news itself. It's about how that news compares to what everyone expected to happen. A company can announce record profits, but if Wall Street was expecting even better record profits, the stock can still totally tank. It is all about the surprise. And, it's not just about the company. The wider economy is this massive force. For example, let's just take interest rates. When they start to go up, it has this really fascinating effect. Think about it like this. $1 you have in your hand today is worth more than $1 you have to wait a year to get. Well, when interest rates get high, that future dollar becomes even less valuable in today's terms. So for companies that are promising these huge profits way down the road, that can be a problem. All of a sudden, their future dreams are worth less in today's money, and their stock prices often take a hit. And all of this leads us to what might be the single most important distinction for any investor. Seriously, this is the core idea of this whole explainer, understanding the difference between price and value. So here it is. On one hand, you have the market price. That's the number on the screen.
It's today's mood, it's the collective belief, the popularity contest. But on the other hand, you have what's called intrinsic value. This is the attempt to figure out what the business is actually worth based on its fundamentals, like how much cash it's going to produce over its lifetime. It's an estimate for sure, but it's one that's rooted in business facts, not feelings. And that gap, the gap between the price and the value, that's everything. That is the entire game for people who call themselves value investors. They're basically hunters, searching for those moments when the market's emotional price is way less than their estimate of the company's true underlying worth. So what's the bottom line here? What should you really take away from all this? First, price and value are not the same thing. As Warren Buffett famously said, price is what you pay, value is what you get. Second, remember, prices move on surprises, not just news. It's always about expectations. Third, markets are emotional. Fear and greed are powerful forces, always in the driver's seat. And finally, when you understand a stock price, you're not just looking at a number. You're really looking at a story about human behavior. So the next time you see that ticker flashing on your screen, don't just see a number.